Hello students, we will continue our discussion on economy. We were talking about GDP and GNP and we have completed that discussion. Okay, so what we have discussed as GDP is, it is the money value of all final goods and services produced in the domestic territory of a country during a financial year. So you know what you mean by final goods, you know what is domestic territory and financial year, all these we have discussed. Okay, then what is GNP? GNP is the money value of all final goods and services produced by the normal residents or nationals of a country during a financial year. So here already we have discussed about final goods and financial year. So here we explained what is normal residents and we have understood what is the difference between GDP and GNP, right? What is the difference? GNP is actually equal to GDP plus net factor income from abroad. I've told you what is net factor income from abroad, and I've told you in India's case this net factor income from abroad is negative, and that's the reason why in India's case GDP is positive or GDP is more than GNP. Otherwise GNP should be more, right? GDP plus something, but GDP is more in India's case because the net factor income from abroad, NFIA, is negative. Why NFIA is negative? Indians earning from abroad is less than foreigners earning from India. So when you take that difference, that is going to be negative. Okay, so I hope you understood this. Now what I'll do is we will talk about 16 important concepts related to national income. You don't want to study all the 16. What I'll do is I'll make it simple. I'll teach you 4 concepts, and with this 4 concepts, the permutation combination will give you all the 16 concepts. Okay, and you are going to understand everything now. So here you will understand all these 16 concepts, and again I'm telling you there is no point in reading any textbooks or anything for these concepts after you attending this session. Okay, and if you are not able to understand it here, you are not going to understand it ever and anywhere also. So let's get started with that national income and related aggregates. All concepts we'll discuss here, all concepts will clear here. Okay, so national income and related aggregates. Okay, so or you can write concepts of national income. So we're going to deal with all the concepts. The first and the most important concept that I want to discuss is gross versus net. Okay, so what is the difference between gross versus net? You see gross salary and net salary. So gross salary and net salary is different, right? So what you get may be net salary, in which some exceptions etc will be there. Okay, so exemptions will be there, some exclusions will be there. So here gross is what we have seen as GDP, gross domestic product. Net is something which you'll see as net domestic product. What is the difference? Let's suppose there is a firm. Okay, so let's suppose this firm is making a production of, let's say, 100 crore. So 100 crore production is made by the firm in this year. So in 1 year, the firm made a production of 100 crore. So what will be added to GDP here? GDP is all about the production. The total production or the value addition will be added to GDP. So here the value addition is actually 100 crore, right? So 100 crore production is there. So what will be added to GDP in this case is actually 100 crore. So GDP is going to be 100 crore. Okay, but during this value addition, you are using certain machineries, and that machineries will have some depreciation. So let's suppose you bought the machinery for, let's say, 100 crore, and next year if you want to sell that, will you get 100 crore? No. So there will be a depreciation. You may get 70 crore or 60 crore or 80 crore. Some depreciation will be there. For example, you take the case of a tax or a car. You bought a car for, let's say, 5 lakh. Okay, and you run it as a taxi. Let's say you generated 2 lakh income. Can we say 2 lakh income you generated in that 1 year? Let's suppose in 1 year you got 2 lakh. Can we effectively say that you got an income of 2 lakh? No. The reason is, if you want to sell this car after this 1 year, will you get 5 lakh? No, you will get 4 lakh, right? So maybe 4 lakh or maybe 4.5, or it can be 3.5 also. So effectively what you got is actually 2 lakh minus this depreciation. Here there is a depreciation of 1 lakh, right? So effectively what you got is that 1 lakh. From that you need to reduce the cost of petrol, all those expenses also. Okay, so I hope you understood what I want to tell you. If you need to get that effective value, the original value addition or original production, you have to subtract the depreciation, like in this car. Okay, so let's suppose here depreciation is, let's say, 30 crore. So 30 crore depreciation is there. So what is the actual value addition here? it is not 100 crore, although manifestly it is 100 crore and that will be added to GDP, but actually it is 70 crore because you need to include that depreciation also. Okay, so that is what NNP, net. So NNP will be here as 70 crore, which is taken into consideration the depreciation also. So this is the most effective concept of understanding the actual production, but we are always using GDP. The reason is how to understand this depreciation. It is subjective, it is value loaded. See, in this car itself, somebody will say 1 lakh is the depreciation, or somebody is coming to buy, he may say that I am ready to pay only 2 lakh. Then 2 lakh is depreciation. But this person, the owner of the car, may say 4.5 lakh. Only in that case, only 50,000 is depreciation, right? So it is very subjective and it is biased, and there is no effective method of calculating the depreciation. So since there is no effective method of calculating the depreciation for understanding purpose, for conventional as per convention, and for comparison purpose, we are taking GDP. We are not taking NDP. Okay, so I hope you understood. So simple terms, what is GDP? GDP is GDP we understood. NDP is actually GDP minus depreciation. Okay, so NDP is actually GDP minus depreciation, or so here it is GDP. Now if it is NNP, what is that? GNP minus depreciation. So NNP will be GNP minus depreciation. So what are you doing is this G to N you are changing, right? G to N, the first letter if you need to change, what you need to do is subtract depreciation. Or I can say net is equal to gross minus depreciation. This is what you need to remember. If you need to get net from gross, avoid that depreciation, subtract that depreciation. So this is the first and most important concept that you need to learn from this particular topic. Okay, and I hope you understood. So net is actually gross minus depreciation. Net domestic product, how can you get? Gross domestic product minus depreciation. Net national product, how can you get? Gross national product minus depreciation. Okay, so I hope this concept is very clear to you. Then we will move to the second concept. Already I have discussed that, domestic versus national. So domestic versus national. So domestic versus national means like GDP is gross domestic product and GNP is gross national product. You know the relation already. We have discussed this, right? So how can you get GNP from GDP? What is that relation? GDP plus NFIA. So if you need to get national from domestic, you need to add NFIA. What is NFIA? The differences in income between Indians and foreigners. Indians earning from abroad and foreigners earning from India. That difference is what NFIA. Okay, so this is what GNP, or if it is NNP, it will be NDP, domestic concept, plus NFIA. So if you need to change the second letter, you can see here the second letter you need to change. Domestic to national, you need to add NFIA. First letter change, gross to net, what you need to do? Depreciation. Second letter change, domestic to national, NFIA. So these are two concepts. Okay, so in simple term I can say national if you need to get, which is equal to domestic plus NFIA. Okay, so two concepts that we have learned is, one is national equal to domestic plus NFIA. So if you have GDP plus NFIA, you will get GNP. Similarly NDP plus NFIA, you will get NNP. So national equal to domestic plus NFIA, net factor income from abroad. Net is equal to gross minus depreciation. Okay, so net equal to gross minus depreciation. So these are two concepts that we have learned. I hope you are okay with these two concepts. Okay, now let's suppose I am telling you I have GDP. I get what from the market? I get GDP from the market. I want to convert this to NNP because NNP is the national income. I'll tell you this, why NNP is the national income. All the reasons I'll tell you after some point of time. We are coming to that, we are reaching to that and slowly evolving this. Okay, so I'm making you to understand all concepts related to national income slowly, and you will understand everything after the session. Okay, so GDP to NNP. What you need to do here is there are two conversions. First, you need to change the first letter, then you need to change the second letter. You know what to do. See, domestic to national, what you need to do? You can see here, national equal to domestic plus NFIA. So let's take this GDP plus NFIA. What you will get? You will get GNP. So we change the second letter. Now GNP you have, so you take that GNP. Now what we need to do, the first letter you need to change. So minus depreciation. So GNP minus depreciation, what you get? You will get NNP. So we have completed this GDP to NNP we have reached. Now we got NNP, right? So GDP, first you convert the second letter or first letter, it's up to you. You can do this process first also. Like you have GDP, right? GDP minus depreciation, you can get NDP. So first letter we have done. Any conversion, any order you can do, no problem. Second, NDP plus NFIA, then you will get NNP. So any way you can perform, but understand only two conversions. First letter if you need to convert, you need to get net means gross minus depreciation. First letter conversion, gross minus depreciation. Second letter conversion, domestic plus NFIA, you will get national. Okay, so I hope you understood. Now the reverse is also possible, right? In that case, you need to subtract. NFIA you need to subtract. If you need to get GDP, you can do the reverse. GNP minus NFIA you can do. Similarly, if you need to get GNP net minus depreciation you need to do. Okay, or net plus depreciation. Earlier minus, now plus. So the opposite you need to do. You can do both, right? So that is the second concept. Third one, a very important one, market prices. Market price versus factor cost. Now, when we talk about market price versus factor cost, what is this difference? See, in your quantitative aptitude classes, I've told you like market price equal to, cost of production or the factor cost, right? Factor cost or the cost price, okay, cost price plus profit. So this was your market price in quantitative aptitude, but here that's not the case. When we talk about factor cost, this is related to value addition. So factor cost means production cost. Okay, so what all things will be there as part of production? Land, labor, capital, and entrepreneurship. So these are the four aspects which are involved in production or value addition. Okay, so in factor cost these four will come. So you can see here land, rent already included if you are taking a rented building for any value addition. Then labor, the wages are also included in factor cost. Capital, that means the interest that you are paying will be included. And the entrepreneurship, that means the profit is also actually included in the factor cost. So in economics, in factor cost, profit is also included. This is quantitative aptitude. This is not relevant now. Okay, so understand in economics, when we talk about factor cost, profit also included because profit is part of cost of production. Okay, so here you can see entrepreneurship is a factor input. So that is why factor cost include entrepreneurship, that means profit. Okay, so that's not profit now. The difference is not profit. Then what is the difference? Basically, market price equal to factor cost plus taxes. So taxes is actually the difference. Okay, so this is how you need to understand market price equal to factor cost plus taxes. Now, when you impose taxes, for some cases, if the essential items, etc., the prices will go so high, so it may not be affordable for poor people. So what the government will do? Government will give some subsidies. Okay, so in that case, market price will be equal to factor cost plus taxes, and subsidies you need to subtract minus subsidies. Now subsidies are given to whom? Subsidies are given to the firms and the advantage will be passed on to the consumer. Just like taxes are imposed on whom? Taxes are imposed on consumers, okay, or the firms, but they pass it on to consumers. So similarly, the subsidies are given to firms and it will be passed on to the consumer. Just like taxes which are imposed on firms and they will transfer the burden to the consumer. Okay. So here now what I'm going to do is market price equal to factor cost plus, if you remember in case of NFIA, we have written net factor income from abroad as the difference. So this difference we will write as net indirect taxes. Okay, so this is basically indirect taxes. Why indirect taxes? Direct taxes are imposed upon wealth, income, etc. of the people. So here we are talking about commodity. This is commodity taxes. Okay, so this is indirect taxes. So here it is net indirect tax. All these things we will discuss in detail when it comes to our taxation module. Okay, so this is net indirect tax. So this is the difference. Market price equal to factor cost plus net indirect tax. Okay, so three concepts we have learned. Market price equal to factor cost plus net indirect tax. Okay, gross minus depreciation equal to net. Okay, domestic plus NFIA equal to national. So these three are very important concepts that we have learned. Okay, now you see GDP we can measure at market price and GDP we can measure at factor cost. Which one we use to measure GDP? Till 2015 we were using this. In 2015 the measurement or the methodology in measuring the national income changed, and then 2015 onwards we are using GDP at market price from 2015. The reason I'll tell you towards the end of this discussion. But which one is better actually? Which one has effectively captured the production? If you ask me, that is GDP factor cost. Then why it has changed, if you ask me, it is basically easy for comparison because you get directly from the market, so you don't want to do any calculations. It's easy to compare, and it is an international best practice, and as per IMF norm we did that. So those are the justification why we adopted this. But why it is best, if you want to know, I'll show you with examples so that you will understand why GDP at factor cost is better than GDP at market price. Let's talk about some case of production. So let's say 2 years. Okay, let's take 2018 and 2019. 2 years. Okay, production. So let's say production here, let's say 100, and here also 100. And let's talk about the factor cost and taxes. Okay, tax, then market price. Then we will calculate GDP at factor cost, and we will also calculate GDP at market price. Okay, so these are the columns that you are supposed to draw in your notebook. So production 100, no change in production in 2 years. Factor cost will be the same, 99. Taxes 1 rupee in the first year, and taxes increased in the second year. So market price will be factor cost plus tax. Don't think about subsidy here, I'm only talking about tax. Previously also, in not all cases subsidy will be given, right? So only few cases. In that case this will be 0. So that is nothing but factor cost plus taxes. That's it. So factor cost plus net indirect tax, in that way you can write. Subsidy can be 0 in most of the cases. Okay, so here imagine we are not talking about subsidy, so factor cost plus tax. So market price will be 10, here it will be 11. So if you calculate GDP at factor cost, 100 into 9, that is 900, and 100 into 9, 900. In 2 years, 900. There is no change in production, right? That's why GDP at factor cost, there is no change. Same. There is no growth. What about market price? If you see 100 into 10, 1000, and 100 into 11, 1100. So you can see a 10% change in GDP here. Okay, so if you take GDP at market price, here in this example you can see 10% change. Is there any change in production? Is there any change in production? No change in production. Actually there is no change in production, but GDP changed. How? Just because tax is changed. And when you calculate GDP at market price, even if there is no change in production, that means even if actually there is no increase in GDP, still you can show that there is an increase in GDP by changing the tax. Okay, but in case if you take it at factor cost, GDP at factor cost will change only if there is an actual change in production. So that is why here there is no change. Why? Production is not changed. So if you take GDP at factor cost, it will change only if there is an actual change in production. But GDP at market price can be manipulated, or it can be changed by increasing the tax also, even if there is no increase in production. Okay, that's exactly what you can see. So if the government want to show higher GDP, what the government can do, government can change the tax, and government can show that there is an increase in GDP if it is taken at market prices. Okay, so that means if you ask me whether the government can manipulate, yes, government can manipulate if it is taken at GDP at market price. Then why we are doing with this? Because I have told you this is an international best practice, and some more reasons I'll tell you when it comes to that particular discussion. Okay, so I hope you understood which one is better. If you ask me, GDP at factor cost is better. That shows the actual production, and all economists actually criticized when we moved to GDP market price, because as per economist, and if you look in this way, now you understood which one is better. Just from this table you can understand. So obviously you will also tell that GDP at factor cost is better. Okay, because in that other way manipulations are possible. So I hope this is clear. So 3 concepts have done. Now the next is, the 4th one is current prices versus constant prices. Okay, so current prices versus constant prices. See, when we talk about current prices and constant prices, what is the difference between these two? The difference between these two is actually inflation, because current prices means it is actually the prevailing price in the market. Constant price means it is actually based on a base year. So constant price is based on a base year price. It is 2011-12 now, and current price means the prevailing price in the market. Okay, so what is the difference between these two? It is the inflation. How much value changed from 2011-12, that is a base year, to current value. Okay, so can I say like current price equal to constant price plus inflation? Yes, I can say, but this is not theoretical way of writing it. It is not correct. It is not a correct representation, but for your understanding, I'm saying current price involves, it is actually the constant price, and over a period of time inflation is there, so that value need to be added. So for your understanding purpose, you can take it in this way, not a theoretical way of representation. Or the opposite also, you can say constant price equal to current minus inflation. So what you need to do to get the constant price, because we need to use constant price for calculation of GDP. Okay, so what you need to do is current minus inflation. But can you do it just like that? You can't do it. Earlier, net is equal to gross minus depreciation, easy to do it, and national was domestic plus NFIA, easy to do it. Market price was factor cost plus net indirect tax, that was also easy to do it. But here you can't do just like that. Okay, here there is a concept which is deflator. GDP deflator is what you need to use. Here it is not addition or subtraction, it is a division. I'll show you what is that exactly, but now I'm just saying I'll explain it with the table. Okay, so basically you need to get GDP at constant price, because that is actually going to give you the real understanding of GDP. Why it is real and why it is better, I'll explain. Okay, GDP at constant price is what we need to calculate from GDP at current. Okay, so GDP at constant actually equal to, you will get from the market, everything is billed at the current price, which involves inflation. So from that you get GDP at current prices, and then you need to adjust something, so you'll get GDP at constant. I'll give you that formula now, and I'll show you how is it used. Okay, so GDP current divided by GDP deflator into 100. So this is what you need to use to make the conversion, not this. This one is just for your understanding, I have discussed, but you can't do this constant price plus 10% inflation. You can't get that value. Okay, so this is what exactly you need to do. I'll show you how you can do this. First, what I'll do is I'll tell you why constant price is better than current prices. Okay, so why constant price is better than current price, I'll first tell you, and then what I'll do is I'll explain you how can you get constant price from the current price. Because from the market, if you collect all the bills and all the taxes paid and everything, what you get, it is at the current prices. So you get GDP at current price, it is easy to get, but from that you need to get it at constant price, because that is a better way of understanding. So two things I want to explain here: why GDP at constant price is better than current price. I'll again draw a table and I'll make you understand. Then I'll tell you, after getting GDP at current prices, how can you convert it to constant price, which is desirable. Okay, so let's understand the first one first. So let me make a table here. I'll take 3 years, because since I'm going to use GDP deflator, I need a base year here. So I'll start from base year. I'll explain why I'm doing this. Okay, so production or years, 3 years I need, 2000, let's say 11-12, that is a base year. I'm starting from base year. There is a reason for that. I'll explain that. 2012-13, 2014-15, or 12-13, then 13-14. Okay, so let's say production. We need production. We need the current price. That means the prevailing market price. We need the base year price. So base year, we know it is 2011-12. Okay, so actually the base year price will be the prevailing market price of the base year. So current price in 2011-12 will be the base year price in the coming years. So let's suppose 2020 will be the base year in future. Imagine. So let's suppose this pen costs 10 rupee now. This pen costs 10 rupee in this year. So if 2020 is actually fixed as a base year, until 2030 the cost of this pen will be taken as 10. So the current year price will be taken as the base year price from here onwards. If 2020 is the base year, if that is accepted as the base year, then the prevailing price in the base year, that is the current price in the base year, the pen cost 10 rupee now, will be taken as the base year price for the coming years. That is what exactly doing. That means if let's suppose I am saying in 2020 now this pen cost 20 rupees, but in 2011 it was costing around 10 rupee, then what will be added to GDP? 10 rupee, if that is your base year, because that was the prevailing price of this pen in the base year. So in 2012, 13, 14, 15, every year GDP, despite the fact that the cost of this pen increased, still you will add only 10, because 2011-12 is the base year, that year price was 10 rupee. Okay, so base year, then GDP at current, GDP at constant. So let's do some calculation here. Let's say this is 100, production is 100, not increased just like before. Now next year it is increased to 150. Okay, now current price here is let's say 10. Next year there is an increase, let's say 15, and next year there is no increase, let's say 15. All these are hypothetical values. Now base year price, see base year price I have told you 2011-12 was our base year, right? This is our base year. So what is the current price of that year? 10. So that will now serve as the base year price for all. So 10, 10, 10. Next year also 10, next year also 10, up to 2020 also 10. Why? Because we are still having base year 2011-12. Okay, now if we are changing it, then only this price will change. If we change the base year from 2011-12 to 2000, let's say 19, then last year price become base year. So as of now 10. Why? Because that was the current price in the base year. Okay, now GDP at current price, if you calculate 100 into 10, so that is 1000. 100 into current price, no, so this one 100 into 15, so 100 into 10, 1000. 100 into 15, that is 1500, and 15 into 15, that is 225, 225, 2250, 2250. Then GDP at constant price, 100 into 10, that is 1000. 100 into 10, that is 1000. 150 into 10, that is 1500. Okay, now here what I want to tell you is, you can see here GDP at constant price, here there is no change. Why there is no change? Because actually there is no change in production. So GDP at constant price is not changing because there is no change in production. And you can change here, you can see here a change of 50%. Why this 50% change is there? Because production changed 50%. So what you can conclude? GDP at constant price will change only if there is an actual change in production, like factor cost. GDP at constant price will change only if there is an actual change in production. And how much, what percentage production changed, exactly the same change you will reflect at GDP also. So here 50% change, here also 50% change, because this remain constant. No, this is not changing. But you see GDP at current prices, here there is an increase. 50% increase is there. Actually, is there any increase in production? No increase in production. But why this increase in GDP? Because of inflation. Inflation is 50%. And again there is an increase here. So why? That is because of this actual change in production. So what I can conclude is GDP at current prices can change either because of inflation, like in the first case here change is because of inflation, or because of actual change in production, like in the second case, or because both. See, actually in the second case there can be an inflation also, even then GDP would be higher, right? So GDP at current price can change either due to inflation or due to actual change in production, or due to combination of both. Whereas GDP at constant will change only if there is an actual change in production. So this is the conclusion. GDP at current prices can change either due to inflation, or due to actual change in production, or due to both. But GDP at constant price will change only if there is an actual change in production. So which one is better? GDP at constant price is better, because GDP at current may change with inflation also. That's not desirable. And that's the reason why we need to get GDP at constant. But do we get it just like that? When we get it from the market, we get it at the prevailing price. So we get it at the prevailing price, right? So that means current price. So this is what we are going to get. What we get from the market is this. From that we need to get this. Now see how we are going to get it. I'll show. Now imagine that at this point of time you don't know about this. Okay, you imagine that this column doesn't exist for us. This column is not existing. Okay, not existing at this point of time. So we have only this current value. From this I need to get the constant value. Okay, so for that I've given you a formula. GDP constant, how can you get? Equal to GDP current divided by GDP deflator into 100. Now what do you mean by, what is this GDP deflator? GDP deflator is actually an index number which measures inflation, like WPI. WPI is an index number which measures inflation. CPI is also. So how will you represent WPI? WPI colon base year 2011-12 equal to 100. For this also base year is 11-12. Why base year is required? To measure inflation. See, simply if I am saying this pen costs 20 rupee. So can you say whether there is an increase or decrease in prices? No. What you need a reference value. So if I am saying before it cost 20 rupee, even now also you can't say. Before can be 2 year back or 3 year back or 5 year back. Okay, so what I need to tell you is I need to have a reference point and a reference year. So this is the base year, this is the reference year, and this is the base point, this is the reference point, base value. Now in 2019, if I am saying the WPI value is 187, what does this mean? The items which cost 100 rupee in 2011-12, now if you need to buy exactly the same items, you need to pay 187 rupee. That means there is an 87% increase in prices. That is 87% inflation is there. I hope you understood. Exactly similar way, GDP deflator also. GDP deflator colon 2011-12, which is the base year 100. Now if I am saying the price is 167, what does that mean? 67% inflation is there. Okay, so that inflation can be understood like this. Now let's move on to this table. Let's talk about GDP deflator here. GDP deflator. So GDP deflator, I've told you the base value which is related to the base year, that is 100. So I've told you this 2011-12 was the base year. So what is the base value in 2011-12? This is 100. Now what happened here, you can see the price. You can see current price 10 to 15, there is an increase. So 50% increase in price. So what will happen with 100 to, what will happen with GDP deflator? 100 to 50% increase, that is 150. Okay, then after that 15 to 15 it is same. So there is no increase. So 150 will remain 150. So I got GDP deflator. Now you see what we need, GDP current that we have in this table, GDP current we have. What we need else? GDP deflator, that also we have. Can we get GDP constant now? Let's see whether we can get GDP constant. So GDP constant equal to GDP current divided by GDP deflator into 100, right? So let's talk about GDP constant now. Let's take GDP current here. This is 1000. So 1000 divided by what is the GDP deflator? 100 into 100. So this will get cancelled out and you will get 1000. So isn't it exactly the same? Here GDP constant you have 1000, we got 1000. So that's how you get it. Let's try the second one. Here 1500 is the GDP current. So 1500, what is the deflator? 150 divided by 150 into 100. So this 150 get cancelled out, 100 into 10, 1000. So isn't it again exactly the same? 1000, here also 1000. So we got it. One more time we can try here. This is 2250 divided by 150, 150. 225 by 15, 15. Okay, so 15, 150. So here 15 into 100, 1500. So that's what we got here also. This is 1500, so there's also 1500. So this is how you can actually get GDP at constant prices from the current price by using GDP deflator. So I hope I have explained what is current prices, constant prices, and I've also explained why constant price is better, because constant price GDP will change only if there is an actual change in production, whereas GDP at current price will change either because of increase in production or because of because of inflation or because of both. So which one is better? GDP at constant is better. Now how can you get it? Because only from market when you get it, it is at the current prevailing prices. How can you convert that? By using GDP deflator, like this you can convert. So I hope you understood these four concepts. Okay, now so we have discussed about four important concepts. Quickly, if you go for net is equal to gross minus depreciation. Okay, then we have discussed about national equal to domestic minus domestic plus NFIA. Okay, then market price equal to factor cost plus net indirect taxes. GDP at current constant equal to current divided by GDP deflator, GDP current into 100. If it is NDP, here you will write NDP, that's it. So these are the 4 important concepts that we have learned. Now how can we get 16 concepts from this? 16 concepts you can like this. So first of all, I'll tell you how to read this term. Let's suppose our GDP, market price, let's take it as current, equal to, let's say, 200 lakh crore. This is our GDP last year. So if you see, how can you read this? You read from here. You can read like this: current market value of goods and services produced in the domestic territory of the country is 200 lakh crore. So this is your first concept. Okay, so GDP MP current, I got one concept. What about second one? You change this current to constant, you get the second concept. So this is the first one. Second one, GDP MP, that remain the same. Now you change current to constant. Now what is the third concept? You can change market price to FC now, factor cost. So third concept with respect to GDP you make it same. So GDP FC, you go for current, then you change current. So fourth one, GDP FC constant. So we got 4 concepts with GDP. GDP MP current, GDP MP constant, GDP FC current, GDP FC constant. All are different 4 concepts. Okay. Now next 4, how can you get us? GDP you replace as GNP. GNP. Again you get 4 concepts. GNP MP current, GNP MP constant. Now MP to FC. GNP FC current, GNP FC constant. So I got another 4 concept. Okay, so 8 concept is done. Similarly, what you can do is NDP MP current, NDP MP constant, NDP FC current, NDP FC constant. I got another 4 concept. Now what is the next 4 concept? Yes, you said it correct. It is NNP MP current, NNP MP constant, NNP FC current, NNP FC constant. So NNP MP current, NNP MP constant, NNP FC current, NNP FC constant. So these are the 16 concepts related to national income. For this, what you need to know? You need to know only the 4 concepts that we have discussed: gross versus net, domestic versus national, factor cost versus market price, and current prices versus constant price. Okay. Now later I'll tell you tomorrow that national income is NNP factor cost. Okay. So this is what national income. So if you have GDP at market price, this is what you get. How can you convert this to NNP at factor cost? You work out on this. I'll discuss it with the next session. Okay, so see you guys. I hope you understood everything that we have discussed. If you have any doubt, you can get in touch with me here. That's my Instagram ID. Join the Telegram channel. If you need any help related to civil service preparation, you get in touch with me. This is my contact number: 98955 77775 or 9790 892 697. Okay, so you can feel free to call me if you need any help related to sociology, optional, or anything in GS. I have complete classes for everything. You can attend the regular classes. We have the online classes, live classes. Everything is there. Test series program is there. Mentorship program is there. Please feel free to call me. Okay, or message me in Telegram, WhatsApp, anywhere. So see you guys. Thank you. So that's about the session. I hope you understood everything that we have discussed today. If you have any doubt in any of the videos that we have discussed so far, you can get in touch with me here. That's my Instagram ID. Okay, or you can join the Telegram channel. You will get all my videos over there. Everything is there. Or you can see here, this is a Telegram channel, or this is the Instagram ID. These two are my Facebook page. You can get in touch with me in any of this. If you want to learn economy with me or history with me or general studies, any subjects, you can, if you need regular classes, you can get in touch with me, or the online classes are available with Study IQ. You will get all those classes. Still, you will get my YouTube videos in this Telegram channel. Okay. So I hope you understood everything that we have discussed. So see you guys. Thank you.